Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And as usual, we're going to review the last couple of days and try to figure out what's going on with the market this week. If you're new, we're going to take about 20-25 minutes, then we open up to some questions. And we talk about anything from individual stocks to sectors to rates or whatever you want to talk about that has to do with the market. And then we'll look at maybe some resistance areas. And today we're going to actually do what I call the 3 R's, rates, resistance, and then a rally, which I still think we may be in the cards. So last week, we had a pretty good start to the week up to about Thursday, and things kind of rolled over. The S&P 500 came within 11 points of its all-time high. Amazing it could do that without people being bullish at all, but we were almost up to that. And then oil started moving lower on Thursday and Friday, and the markets kind of backed off with it. The wheels kind of came off here the last couple of days, and actually the Dow's has worst 4-day performance since about February. So things are slowing down a little bit. Oil has fallen back below $50 a barrel. I think oil looks a little bit toppy in here. We want to watch that again. I think if it falls below $47, you could get another pullback down into the mid to low 40s, which could be a little bit of a problem for the market. Anyway, we had the FOMC meeting, June FOMC meeting starting today. The CME group FedWatch pegged the chances of a rate hike today at about 4% as of this morning. Also this week, a poll came out actually on Friday and again today, showing the voters were almost evenly split on the United Kingdom's possible exit from the Eurozone, so that's causing some problems. And we had interest rates in Germany, Japan, the United Kingdom hit all-time record lows last week, probably continuing this week too. I haven't checked today. And with all that going on, the major averages finished mixed and still close to their all-time highs, which is pretty amazing. Okay, now yesterday, the Dow Jones and NASDAQ fell below their 50-day moving average, which is a little bit of a bearish sign, and the S&P 500 closed right on it, as I held support there for the first time. But we broke below those averages again today. The NASDAQ is down here testing its 200-day moving average today as we speak, and but the Dow Jones and the S&P are still holding above major support, and we'll get into that in a little bit after this. Okay, but crude oil lower again today, like right about 48.30, I think, right now. The global markets, especially Europe, they can't seem to get past this Brexit deal, which I guess I understand that. So there's a lot of things to shake things up for investors, and we're going to try to go over a few of those things and see how they might affect your portfolio. First thing I want to look at today is something called on interest rates. I think if you let me close this thing down here. What I'd like you to do, if you have a pencil and paper, is to take on this first slide. I want you to write this down. This is a web address for the CME group. The CME group is part of the Chicago Mercantile Group. It's the largest options and futures exchange in the world. This isn't where economists go on TV and talk about rate hikes and what they think is going on with the economy, that kind of thing. This is where actual traders put their money. And it's good for you to go to this site and just check on rate hikes once in a while, just see where the market thinks rates are going. Okay, so in this case, when you go to the page, if you've got that, you can come back to this and get it later on. But what you'll see is this tool here. It's a CME group FedWatch. And what this group does, it's the future players. They look at the market participants, look at the following, the probability of an upcoming Fed rate hike. Okay, as of this morning, we were actually at 2% of the implied probability for this. So the odds are probably non-existent that we'll get a rate hike today. I think that's pretty much on the table, especially after our last jobs report. But what's interesting on this thing is if you go on out a couple of months, you get down here at the bottom, you can press these numbers and it'll pull this graph up. Okay, we go into July, and we're still only at an 18% probability of a rate hike even in July. Okay, you can go out here, you look the next one out here, September, implied probability is 33%. So still not much of a chance that we're going to see rates go up even in September. We don't even, in fact, get to the probability of at least 50% until we go out to December. So I guess December we get to December 14th, we're up to 53%. That was probably about a week or two ago. That was up to around 68%. So as you can see, the market is implying that they don't think that the Fed's going to have enough economic data to justify moving rates up anytime soon, which is good for the market. You know, a lot of this has been it's kept the floor into the market going forward for the last couple of years, and according to this, we should still have that underneath the market going forward. Okay, now this is on the smart chart. This is an ETF. It's the iShares Barclay 1 to 3 year Treasury bond. The symbol for this is SHY, shy. You can put this in here. You can see that we're bumping up against resistance. But this is also showing you here. It's a little bit extended over here with the stochastic up-down ratio shows that it's under accumulation. Well, this tells you that on the short-term rates, traders aren't expecting rates to go up either. This is the actual bond itself. So when this is going higher, it means rates are probably going lower. So as you can see that, you can kind of follow this. Again, we're bumping up here against this resistance level. If you would see that really take a leg higher than that, then you might start to have to think that possibly the Fed might be thinking about actually lowering rates again, which I don't think is going to happen at this stage. But that's a chart, an index that you want to watch. Okay, the next one is the iShares Barclay 20-plus year Treasury. As you can see over here, this was where's December? December was back in here. You saw this thing starting to get ready for when we did raise rates, and then we saw where that wasn't going to happen and markets started tanking. You know, the yields came down. And over here, we're actually kind of breaking out. This is a little bit troubling in the fact that this is going to narrow the yield curve, which when we've talked about it before, when you get to the yield curve narrowing, and then actually when it gets inverted, it usually predicts a recession going in. I don't see that currently yet, and I think when you look at some of the Fed watch numbers, they only project about an 7% chance of a recession 12 months from now. But this is another one. The symbol on this is TLT. Again, it's an ETF that trades the 20-year T-bills, and you can see that we're breaking out that. So that's also telling you that the traders aren't expecting any kind of a rate hike. Okay. This is another address that I want you to go. You know, well, it's important to know when and if the rates are going up. If you're retired or nearing retirement and you do have a bit of a bond portfolio, and for the young guys, you probably don't want to hear about bonds right now, but you know, for our older clientele, you do probably have some of this. If you write this down, this goes to FINRA, which is stands for the Financial Industry Regulatory Authority. And with this we're going to talk about something called duration in bonds. Okay, so write this down. If you don't have it, you can go back to it later on. But duration is what an interest rate hike could do to your bond portfolio. So if you own bonds or have money in a bond fund, there's a number you should know, and it's called duration. Although stated in years, duration is not simply a measure of time. Instead, duration signals how much the price of your bond investment is likely to fluctuate when there is an up or down movement in interest rates. Okay, the higher the duration number, the more sensitive your bond investment will be to changes in interest rates. The reason I'm bringing this up is, although I don't expect rates to be going up here the next couple of months, they certainly won't go up, I don't think, in September before an election. But going into the fall, if you own bonds, you're going to want to be aware of what they can do, and if you're not going to hold them to maturity, you may want to go into this duration stuff and read a little bit about this. Okay, with the duration details, to find your bond fund's duration, look for it in the fund's fact sheet, often in the bond holding statistics section. Finding the duration of an individual bond can be a bit trickier. start by asking your investment professional or the bonds issuer. There's also online calculators, and that previous web address that I had on there for FINRA, that will take you to areas where you can figure out the duration for your bond portfolio. And I think it's something that you need to be aware of as you start seeing the economy pick up and how it's going to affect your bond portfolio. A lot of guys will just figure, well, I got bonds, I'm safe, I'll just ride them out. But if you got a 30-year bond and you're 80 years old, you're not going to be riding that out to maturity. So these are things that you may want to look at and see how it's going to affect your portfolio. Okay. We talked a little bit about the duration numbers. Let me go back one more time. Another thing that the duration thing will go into on the FINRA website. It'll talk about how if rates rise 2% from today's level, if you own the medium grade investment grade corporate bond with a duration of 8.4, which let's say is a 10-year maturity, 3.5% coupon. Okay, if goes up 2%, you're going to lose 15% of your market value on your bonds. That's why this is important to know. It's easy to say, well, I don't want to pay taxes, or I'll just hold on and sell it when I'm ready because I need the income. But you can get an awful lot of income if something goes down 15, 20, 25%. Okay, a similar grade bond with a duration of 14.5, which would be, say, a 30-year bond with a 4.5% interest. Okay, if the rates go up 2% from today's levels on that, you're going to lose 26% of your bond portfolio of what it's worth. So, again, just because you're getting 4%, my dad is a good example of this. He goes, well, I might get my 4 or 5% yield. That's what's keeping me going. I want the income. Okay, with that we can sell this thing at $100 a bond, and then we can go ahead and take money out of the principal. There's going to be a lot of dividends to make up that 15, 20, 25% that you're going to lose on your principal once the rates begin to move. So the sites that I gave you, I think it's important you can go in there and kind of study that. It's pretty well laid out, and it's not a hard thing to understand. Okay, so let's go into the second R, and that's resistance. We talked a little bit about last week. We saw the S&P 500 has been chipping away up here. This is a weekly chart going back to 2014. As you can see, we've got clear resistance up here around 2109 to about 2120. We have the 50-week moving average crossed below the 100, which is troublesome. It's already flattened out, and I think you'll start to see that move up over here. The thing was a little bit overbought. We're seeing the markets work off their overbought condition here in the last week or so. But the pivot here, let's just go to the daily chart. As you can see over here, we're battling up against this area again, all the way back here, going back to last May and June. Now, one thing about resistance, the more times you hit a support or resistance line, the stronger that becomes. But it also means that once you break through that resistance or support line, the bigger the move is going to be. So that's while we're chipping away from this thing, I think you're probably going to take it out here in the next month or so. I think we will hit new highs. We'll go over that in a little bit. But anyway, on this point, on this chart right here, the pivot point for the S&P 500 right now is 2075, and we're at 2069 right now. So we did break that, which is below the 50-day, which is going to set up for support on. Let's see, the support for the S&P 100 is 2047. So we still have about 20 points to the downside, another 150 points. 2047 would be down in this area where we were on June 1st. That area is at the end of May. So that would be your first support area right in there. Now to the upside, resistance for the first resistance for the S&P 500 is going to be this 2124 area, which is the top of the line. If we can break through that, our first target is 2153. Now that's using pivot targets and not the Elliott wave targets that we used last week. So these would be a little bit shorter, lower than what we talked about last week. Okay, the next one is the Dow Industrials. Again, we're bumping up against this resistance area from the old highs. It's not quite as strong as the S&P 500, but we have resistance up here at 17,938 to to about 1816 when you draw it in on the smart chart. Okay, we're working off the overbought condition. We got up to the 80, rolled over. We got to 74 or so on the RSI 14-day indicator. It's backing off of that. You want to see that stay above 40, which it probably will. I think it will. And the pivot line on the Dow right now is 17,685, and we have gone below that in here. So we're at 17,643 right now. So first support for the Dow will be 17,433, which is right in this area where we came down here for the May and June low in here. So you may get a chance to come down to that area. I would be a buyer of that in that area. Now, one of the reasons why I'm still bullish on the market, and to stress my point, I want to go look at the recent AD line. Okay, this is while we've been moving up here, this is the advanced decline line. This is showing we're hitting all-time highs on this, even way higher than last May. What this is telling you is that traders are buying stocks. Now, volume's way down, but the accumulation and the broadness of the rally is good. We're seeing an expansion in new high and lows, except for the last couple of days. If you take this advanced decline line, go back to last summer, here we were after coming off of the all-time highs over here. Here we are on the rally into October. The rally into December was not quite as broad-based, but then once we got back here in February, things were on go. You can see this big movement here. It's a very strong move. This is usually a leading indicator for the market direction, and that's also confirming that we should probably get a bounce through here after we break through the resistance levels. So our first resistance, I say, will be about 1837 at the top. Our target using pivot points for the Dow would be 18,287. Okay, now here's the NASDAQ, and not so much on this one. Okay, we didn't make it up to the old highs back here in December or the old highs over here from April, but that's okay. And the reason I say that's okay is back here, especially, and over in here, all you heard about was the FANG stocks. Okay, it's comprised of an overweight segment of the index, and those four stocks really gave an extra boost to the NASDAQ at that time. Okay, so since right around in here, the FANG stocks have pretty much been trading sideways, and what that means is you're seeing the rest of the market, some of the small caps, maybe some of the healthcare, the biotechs, that type of stock, semiconductors that are leading the market higher. I think once we break above this area, resistance area right here, we can come up here and go above this trend line, this descending trend line, and start to push up into 5,000s. Okay, another thing that I like about this is the Philadelphia Semiconductor Index. Okay, if you take away this right side over here, okay, here's where the FANGs were leading. Okay, the FANGs were still going over here. Okay, well, now the FANGs are going sideways, and what you're seeing is semiconductor index breaking out on its own. This is the Intels. This is all the different, it's a tech-heavy index with the NASDAQ, and this shows you that a lot more are participating rather than just the FANG stocks. Okay, so that's also a bullish sign for the market going forward in the summer. Okay, the next thing that I like about it with the NASDAQ, this is the tech sector spider. The tech sector is XLK on the ETF, and you can see we're right over here bumping up against all-time high. This was a 52-week high that it made here back in April. Okay, we haven't quite made it up to there yet, and part of that is, again, this will be blamed also on the FANG stocks because if you take a look at charts like Apple and Facebook's going sideways, Google's kind of going sideways, you're not getting that participation. If they were participating even half as much as they were back in here, this would be up here making new highs. So, with the Philadelphia Semiconductor punching up in here almost to a new 52-week high. This is a high. Old high over here is 44.72. Today we're trading about around 43.40. So we're holding up over here on this 50-day moving average, which is bullish. And I think you'll come back here and test that. That kind of leads me to believe that we should get that summer rally. Here's a chart of Apple. As you can see, this is just going the wrong way. It's bouncing up here, trying to get above its 50 and 100-day moving average. You can't do it. Our 14-day RSI has turned down. Also, the MACD long-term has gone bearish too. So As long as Apple's struggling, I think it's going to be holding the NASDAQ back a little bit, and maybe even the Dow to a certain extent. But again, once these begin to show a little bit stronger participation, I think you're going to have a chance to make a summer relief rally. So just to wrap it up real quick, and we're going to open it up to questions if you have some different stocks or you have any questions about the rates or what this resistance line can mean. Even though when we're chipping away at these resistance levels on these indexes, the only thing that I see that we're lacking is volume. And to tell you the truth, that doesn't always have to be a bad thing, because price is the ultimate indicator of where something's going. The volume will confirm it. I think that once you begin to break through that resistance, you have a lot of money on the sidelines that's going to come in off the sidelines and want to start chasing the market a little bit. Now, another thing they always say is the market climbs a wall of worry. Okay, you've got China's economic data slowing down. You got Brexit coming up here in another week. You got the threat of higher rates later in the summer. You got the ridiculous presidential election that will probably cause the market to stall again, maybe in September or October. So the market has more than a wall to work on. I think that as we start to battle that, just the fact that all these things the market's facing all these different problems in here is bullish overall, that it can't knock it down. And of course, give some credit to that, to the zero interest rates. But we're bumping up against the resistance, and the more that line is touched, the more pronounced that support resistance line becomes, and the stronger the move is once we break through there. Okay. One last thing that I'm going to mention here about why I like the market going forward, and that's earnings. Okay, we're expected right now for second quarter earnings to be down about 2.6%. Analysts, however, are looking for positive earnings to show up in the third quarter. We've had, I think, 6 quarters now? This will be the 6th quarter of negative earnings. We could get positive earnings in the third quarter. They're projected right now at 1.3%, but for the fourth quarter, all of a sudden we spike up to earnings for the S&P 500 may be up 7.6%. The market historically likes to look ahead 6 months, and so they're not concentrating right now, the big money managers, on what's going to happen here in July and September. They're going to start to reposition themselves for what's going on here towards the end of the fourth quarter. Of course, the uncertainty as we go into election will cause the market to stall. That's also when the CTI, the long cycle, bottom sometime towards the end of the year. That's tied with the 4-year business cycle, which as we start to ramp up earnings, that should begin a new bullish business cycle, and that should break us out here towards the end of the year. So for the longer term, I think we can break out of this resistance and start a new leg up sometime either before the end of the year or as we start the next of the year. Okay, before I open it up for questions one last time, next week I had some questions that came in this week about the VIX and the VXX and all these different volatility gauges that traders follow. And rather than just touch briefly on them, what we're going to do next week is we're going to go over the different volatility gauges for crude oil and for the NASDAQ and the Russell and the S&P 500 and show you how you can trade some of those to put on some hedges for when, not necessarily when you think the market's just going to tumble or anything like that, but even if you're got some uncertain things like the Brexit vote, that's caused the uncertainty in the market. So maybe you don't think the market's going to go down for the next 3 months. But these gauges volatility gauges are very quick moving, and they're usually something that you want to play for a matter of days to a matter of a week or so, because you're not going to catch it when it spikes up 20% or 25% in a day. So if you know when it pays to put them on, and the type of position that you can add to your portfolio to play that just for a couple of days when you have a market moving event like Brexit coming in, we'll go over that and maybe we can maybe help you out to understand those a little bit better. Okay, I don't see any questions coming in here yet. If you have some, go ahead and type them in. Okay, I don't see anything going. Okay, so we'll wrap it up this week. Again, tomorrow we have the conclusion of the FOMC meeting. I don't expect to see much. I would imagine we'll get some dovish undertones to that. And POT, potash. Okay, we got a little bit here. Okay, let me, since we have some extra time, I'm going to close this down and go to the chart. Let's see. I'm not sure what this is. You know what this is, Will? Can I just close that, or did it just stay up?
Just minimize it.
Minimize it?
Yeah.
Okay. Can you see the chart? Can somebody tell me if they see the chart or not? Oh, here we go. Yes, that's my bad. Okay. All right, here we have potash. This is the, let's see, make sure I'm on daily. Let's go daily. A big fall off on this. You've had it, but you do have a nice bottoming position over here. You have the long-term MACD going bullish in here. You not see the chart? What if I go? What do I close that? You see it now?
I think you got it.
Is that good?
Are you sharing your screen?
Yep. Screen share. Still can't see it. Boy, okay, with the potash, we do have a strong bottoming. It's actually been in a bottoming process since about the middle of January. Been trading between 16 and 18, so it's been in a real tight zone. The 200-day moving average on potash is coming in here around 18, about 1850 or so. So you may want to wait until it breaks through that. I don't think I wouldn't be an aggressive buyer here, but certainly it's in a bottoming position, and I think at this stage, if you start to see things pick up. Now, one of the things, if you like potash and fertilizer, you may take a look at some of these commodity ETFs. Like one of them I like is the grains. It's JJG, which is up about 10% over the last week or two. You have a lot of different commodities making these things. I'm sorry that I can't show you these charts right now. I'm not sure what's going on. No, I can't. I'll look at EA real quickly too here. Okay, Electronic Arts, big gap over here. It is overbought. It's starting to work off its overbought position. A little bit of negative divergence on the 14-day RSI. It's got resistance up here to 76.96 to 78.09. Going back, I don't know, a couple of years. You're up at a new high on this thing, but what you want to watch is if it breaks down from that gap, which was, it opened up on that gap around 73.63. I would keep a stop on that, where if it sell stop maybe around 72.66, somewhere up there, to make sure it doesn't come down here and retest this gap, because sometimes when a stock will gap up, it can fill that gap. But right now it looks fine. It seems to be consolidating. The big jump up, a little bit overbought, but on the stochastic, but not on the 14-day RSI. You're still at about 55. So I think you can probably go sideways. Once the market starts to move a little higher, you can probably make some money on that one. I think that looks fine. Okay, since we're not getting the questions, well, here's let's see. If we want to watch this again, how soon till it gets posted to be able to watch? This will be up online probably in about an hour and a half. That'll allow you to get those web addresses that I put up there. And again, I think that's those. What I wanted you to get out of it today was to go to those two websites so you can kind of follow the way where rates are going and follow on the way what the traders and people with their money are saying about rates, not just an economist who's reading a book and and looking at data. These are the people that are putting their money where their mouth is, and it's very important. They're going to be more accurate than what the economists are. So that'll be good. I'm going to go ahead and wrap it up because we've been going for about 30 minutes. If you have any more questions on what we talked about today, please feel free to send me an email to the doc@marketedge.com, and I'll try to get back to you. Again, next week we're going to talk about the volatility indexes, and I hope you join us then. All right, have a good week.